All right, good. Let's get started. We have a lot to go over today. So let's get started. Yeah, put your questions in the Q&A. I don't know if Jonathan's got the upvoting feature turned on where you see a question that you would like to upvote it. You can click on that. I'm not sure if you have that or not, but we'll go through this the best we can. Okay. First of all, a little bit about me. I'm a CPA, an EA, and a USTCP. So those are my tax credentials. And my financial planning credentials are I'm a CFP, a PFS, and an AEP. I'm here in Redwood Shores, California. I was born in San Francisco. I've been a tax professional since 1986, and I love talking about taxes. And I also teach taxes at the College of San Mateo, and I really enjoy doing that. So let's get started here. So here's what we're going to cover today. It's a lot to cover. I'll go relatively quick, but we're going to introduce with major tax law change this year. The One Big Beautiful Bill, which you've heard a lot about. We'll start with that. And then we're going to go over all the changes in the 1040. Lots of changes to the form. I'll point out what you need to know. Most importantly, we have some new deductions on Schedule 1A. We'll go into that in a little more detail, how to qualify, what doesn't qualify. And then there's a new account called Trump accounts. Now, if you don't like that name, call them 530A accounts if you don't like that name. And hopefully the financial institutions will put that in their paperwork. And we'll close with some updates to California. We've had some changes to the California forms. All right, so that's what we're going to cover today. And let's get started. So, first of all, let's start with the One Big Beautiful Bill Act. You might hear it referred to as OB3 or OBBBA, HR1, or in the IRS form instructions, it's called the 2025 Act. Whatever you want to call it, it was signed into law on July the 4th, 2025, and made a lot of changes. Now, why did we have to have this law? Well, it's because back in the end of 2017, we had another big tax law change. It was called the Tax Cut and Jobs Act, and that took into effect on January 1st of 2018. But that law was passed under a process called budget reconciliation. What that means is that many of its provisions expire on December 31st, 2025. So the Tax and Jobs Act lowered tax rates and brackets, added a lot of tax cuts to the law, and lowered the estate tax exemption. And so we're all, or raised the tax exemption, I meant lowered the amount that people are paying estate taxes. And so we were all concerned that after December 31st of 2025, that law is going to expire. It's going to sunset. Then we'd have higher taxes and all those kind of things. Well, anyway, we had the One Big Beautiful Bill. It's called the One Big Beautiful Bills because there was hundreds of bills that was introduced in the last couple of years, and it was consolidated into one bill. And by the time it passed, it was like 870 pages. It started around 1,300 pages, but it got shrunk down to 870 pages. So what did it do? The most important thing it did was this extended many of the provisions of the Tax Cuts and Jobs Act. So it extended the lower tax rates and brackets. So we still have 37% as the top individual bracket. We still have the beneficial capital gains rates, which is 0, 15, or 20%. So we still have historically low taxes as compared to previous years. For many people, it extends the increased estate tax exemption. So for 2025, you did not have a taxable estate until you had more than $13,990,000 of assets, taxable assets. And starting in 26, it was raised to $15 million. So most Americans are not paying estate tax. So that was a big change. We had four new deductions that we're going to be talking about. No tax on tips, no tax on overtime. There's a new senior deduction and no tax on car loan interest. So you can deduct your interest on car loans only for new cars. starting in 25. And also, one of the criticisms of the Tax and Jobs Act was that the state and local tax deduction, known as SALT, was limited to $10,000. It wasn't eliminated, but it was dropped to 10,000. Well, here in California or here in the Bay Area, we pay a lot more than $10,000 in state and local taxes, which includes property taxes and state income tax. Well, it's been increased to $40,000. So that's an interesting change there. So we're going to talk about these in detail. So let's take a look at the new 1040, the 2025 1040. First thing you're going to say is, wow, there's a lot of new boxes. Yeah, a lot of new boxes. So let's go over these boxes here. So this pulls it up a little bit here. So on the top of the return, let me see if I turn on the pointer here. So you'll notice that these were not there before. Combat zone. If a taxpayer deceased or a spouse deceased, we check this box here and enter the date that you're deceased. Before this, you would write it on top of the form, or your software would type it in. Well, it was hard for the IRS to capture that information, so now we have boxes for that. Name and address, no change there, but there's a new box here. Check here if your main home and your spouse's, if filing a joint return, was in the U.S. for more than half of 2025. Check this box here if that's your situation. So we didn't have that before. So that's a new box there. Let's go down here to filing status. So it's important because your filing status is important because it's going to affect your standard deduction, your tax rates, and all those sorts of things. So we got single, married filing jointly, married filing separately, head of household, qualifying surviving spouse. Now, I'm not going to go into the details for which filing status you're in because that'll take a whole class in itself. And also give you a heads up that the head of household filing status is a bit of a complex filing status, the qualifications and all that. Many people check this box even though they don't qualify, and that's caused a lot of trouble, caused a lot of extra work for the IRS to audit taxpayers and collect money from them for checking the wrong box. So during the debate of the One Big Beautiful Bill, Congress thought, let's just get rid of this filing status so we don't have to deal with it. But that was in the House version, and the Senate version was brought back, so we still have that. Now there's a line here that started last year. It says, if treating a non-resident alien or dual status alien spouse as a U.S. resident for the entire year, check this box, enter the name of the spouse. The reason that's there is if you're a non-resident alien or a dual status alien, you cannot file a joint return if you're married to a non-resident alien. But if you check this box, you can be treated as a U.S. resident for tax purposes for the entire year. So what does that mean? It means that the income of that non-resident alien spouse will be taxed on his or her worldwide income. So there's some tax planning considerations to think about there. So you just got to be careful about that. But the IRS now has a box there to inform them of that situation. Okay, let's move down here. You see the next line is digital assets. Now, this is the same as the previous couple of years. It used to be called cryptocurrency or whatever, but digital assets is more encompassing. Now, the question is at any time during 2025, did you receive or sell, exchange, or otherwise dispose of a digital asset, or if you had financial interest in it? So this question hasn't changed, but it's important to the IRS, right? Because look where the question is. It's underneath your name and address, but it's above your dependents. So the IRS thinks this is more important than your children. Now, you say yes or no to that. Now, don't lie. Lying is a bad idea because the IRS already knows the answer to it. So don't lie. And, some people think the blockchain is confidential. No, it isn't. The FBI has broken the blockchain, so they can get into that. So, and we're going to talk about a new form regarding any sales of digital assets. So, yes or no? Basically, if you sold or made any money in digital assets, you have to say yes. If you're only holding on to digital assets like cryptocurrency or buying them but didn't sell any of them, you can say no. That's what this question's about. The next section are dependents. Wow, look at this. They've really expanded on this, right? They want the first and last name, their social security number, relationship. Check if you live with more, if live with you for more than half of 2025. Yes, and if it's in the U.S. And then line six is check if it's a full-time student or permanently and totally disabled, because these two uh, categories affect whether the child can be claimed as a dependent or not. And then line seven are the credits. We have the child tax credit. That's for a child of 17 and under to qualify for the child tax credit. That's been increased by the One Big Beautiful Bill. It was $2,000. Now it's $2,200 for children 17 and under. If you're over 17, then you'll have the credit for other dependents. That's a $500 credit. And that could be your parents if your parents are living with you or you're taking care of them or whatever. Again, we almost lost this credit. Um, Congress thought, why should we have this? It's $500. It's not going to make a difference. So, but anyway, it was brought back and it's still there. Here's a new question on the bond on the form under dependents. Check if your filing status is married filing separately or head of household and you lived apart from your spouse for the last 6 months of 2025, or you are legally separated according to your state law under a written separation agreement or decree of separate maintenance, and you did not live in the same household as your spouse at the end of 2025. So your filing status is based on your marital status on December 31st. Yeah, I watch those New Year's shows every year, and I always wonder why these idiots get married on New Year's Eve, Because you're treated as if you're married for the full year. What do you know about this person you're marrying? Have you checked their credit history? Do they owe back taxes? I don't know why people don't think about those things. Well, this question is for whether the taxpayer qualifies to file as head of household. If you're still legally married, but you have to live apart for the last 6 months of the year. And, when do people usually leave? When they leave the house, whatever. They usually leave in August, right? Well, guess what? That's not 6 months. So, a lot more nosy questions on the tax forms, and you gotta answer them accurately. Don't lie. Lying is a bad idea. Lying is a bad idea. All right. So we have a new form that takes an effect this year is Form 1099-DA, digital assets. So if you have any sales of cryptocurrency or any other digital assets, starting in 2025, the tax forms line, what does it say here? Is it 1F? Proceeds. You got to report the proceeds. However, in most cases, what's this? One I? No, I'm sorry, wrong one. One G, cost or other basis. For most of, if you get this, most of the time it's probably going to be blank because the reporting for cost basis is probably it's not going to start until 2026, and it's only for digital assets you purchased in 2026 or later. So, that's what's going to happen this year. So, if you are involved with any of these cryptocurrencies or whatever, my suggestion is to work with an exchange such as Coinbase, Robinhood, Kraken, or whatever. Make sure it's a good, well-known crypto exchange because they offer a service called an 8949 service. Highly recommend you pay for that or sign up for it because they'll do the calculations for you. Because I'm a tax preparer, tax professional. I don't want to figure that out because one thing is going to take a lot of time. It's complicated, and the clients are going to say, "Well, why am I going to pay you all this money to figure this out?" It's like, yeah. So I'd rather have the exchanges do it, and we'll just rely on that. Is it perfectly accurate? Probably not, but hey, it's close enough. So that's my number one suggestion. Well, if you're going to be dealing with this. Now, if you're on the blockchain a lot, well, good luck with that. All right. So if there are questions about what's my filing status or who can I claim as a dependent on the IRS website? They got this thing called the Interactive Tax Assistant. It's not AI, but it's a question answer tool that you can use, especially if an argument with someone. Oh no, I'm head of household. No, you're not. Yes, I am. You can go through the Interactive Tax Assistant, answer the questions as accurately as possible, and at the end of the ITA, the Interactive Tax Assistant, the website will say, yeah, you qualify to file as head of household. No, you don't qualify as head of household. You got to file married filing separately, or you're single, you're married, or whatever. Okay. And who can I claim as a dependent? That's pretty tricky. So these are two very important questions. So here's a link to that. Here's a picture of the IRS website. Just type in ITA, Interactive Tax Assistant. The IRS is always adding more and more to this. So the first section is filing requirement, filing status. These are quite helpful. And there's more. There's more here. If you have any questions about any issues or whatever, the Interactive Tax Assistant is quite helpful. So I highly recommend that in case you have questions. Now, it doesn't replace a tax expert or a tax professional, but it's a helpful guide because when we read the instructions to the forms, it can be quite confusing. So this could be quite helpful. And it'll point you to more resources to read about. Okay. All right, so let's move on down to the next part of the 1040 is the income section, lines 1 through 11. So let's go through this. I'm only going to highlight the changes here. So of course, line 1A is your box 1 of your form W-2. And then we got interest income, including tax exempt interest. I know a mistake a lot of people make is that why do I need to tell the IRS my tax exempt interest? It's tax exempt, it's not taxable. Well, it affects some other calculations. And when we talk about modified adjusted gross income, Maggie. So in some cases, that information is still quite important. So you always have to report the tax exempt interest. And then line 2B is taxable interest. Line 3 is your dividends. That's coming from mutual funds, ETFs, stocks, and those kind of things. And then we got line 4 here, which is IRA distributions. Make sure you give all your 1099-Rs to your tax preparer. That's what's the number one cause of IRS notices is you don't give it to them. Especially people say, well, I did a rollover. It's tax-free, right? So why do I need to give my 1099-R to my tax preparer? Yes, you still need to report it. And what's new for 2025 is we have a box here, box 1, that says rollover. So if I took money from an IRA and I rolled it over to another IRA, you get a 1099-R. You're telling the IRS that I rolled it over within 60 days. And then 4B is the taxable amount. We now have a new box here, box 2, qualified charitable distribution, QCD. Big fan of that. We now have a box for that. That's awesome. So what is the qualified charitable distribution? It's for people who are 70 and a half and older. Once you turn 70 and a half, you can roll over up to 108,000 in 2025, 111,000 in 2026 of your IRA to your favorite charity. So I go directly from the IRA to the charity. Also, you have a great tax planning opportunity to roll over up to $55,000 in 2026 of your IRA to a charitable gift annuity. Talk to your favorite charity about that. They can explain more of that to you. It's a once in a lifetime. So my suggestion, if you want to take advantage of that, go big because you only do it once in your life. 55,000. I think that's great. Now, if you're 73 or older, you're subject to what's called required minimum distributions, which means you have to take money out of your IRA. Now, the beauty of the QCD is if you roll over your RMD to your favorite charity, it fulfills your required minimum distribution requirement, and it's not taxable. And most people aren't itemizing anyway, so it's a great benefit. So, if you're subject to required minimum distributions and you give that to charity, it's not going to be taxable and you fulfilled your required minimum distribution requirement. I think that's awesome, right? So glad we have a new box for that. But I still think for a documentation standpoint, make sure you get the thank you letter from the charity and also um, either the statement or some kind of a receipt from your IRA trustee, IRA financial company that shows the money going straight to charity. You can't take it, it can't go to you, it can't be made payable to you. It could be made payable to charity. They can give you the check and you give it to charity. Big fan of the qualified charitable distribution. Definitely look into it. Take advantage of it for all your charitable giving if you're 70 and a half or older. All right, line five, pensions and annuities. Again, that's another 1099-R. The difference between line four and line five is there's a box on the 1099-R that'll indicate whether it's an IRA or not. And this would be coming from an annuity, from an insurance company, or from your pension, right? So, so what's new is we have box one here, rollover. So let's say my 401k plan, I left my company, I want to roll to an IRA. You check this box, it went to an IRA, not taxable. What's the advantage of doing that? Well, there's a lot of tax breaks that are available to IRAs. They're not available to a 401k or 403b plan, such as the QCD. You cannot do a QCD out of a 401k or a 403b. So that's a big advantage there to consider. Also, if you leave in the 401k or 403b, you're stuck with their investment choices. And also, you have a lot less flexibility when you do distributions and all that. So with an IRA, you can invest in anything you want to. So it's a little more flexible, a little bit easier, but there are other considerations to think about. We have a new box two here, PSO, Public Safety Officer. So what does that mean? If you're retired SFPD, SFFD, sheriffs or whatever, the up to $3,000 that was used for health insurance is tax free. The law changed a few years ago. Prior to that, had to go directly from the pension to the health insurance. A lot of people complain to the IRS about that. That says, oh, it's not physically possible. So now the IRS allows you to write a check or make a payment to the health insurance and you can deduct up to $3,000 from the pension. So $3,000 is tax free. So we got the new box here. All right, moving on here, we got line six. That's Social Security benefits. So 6A is the gross amount, 6B is the taxable amount. So not 100% of your Social Security is taxable, up to 85%, depending what your income is, or 50%. Most people are probably at 85% taxable because the income limits hasn't changed in what, 40 years or so, over 40 years. So it needs to be changed by an act of Congress. So a lot of people are taxable. But I want to point out that we have line 6C here. If you elect to use the lump sum election method, there are some of you who might be taking advantage of that this year because last year we had the Social Security Fairness Act, and that was signed by President Biden. And what that did was it repealed the WP and the GPO restrictions on collecting Social Security. So if you are, let's say, a retired school teacher, retired police officer, firefighter, or whatever, where you get a government pension that you didn't pay into Social Security, but you had a previous job that you paid into Social Security, or you have a side job. You know, a lot of firefighters have side jobs. A lot of police officers do. They have security jobs or whatever, right? That you paid into Social Security. Well, under a previous law, um, you didn't get your Social Security benefits because you had your government pension, or you have a pension uh, or you work for an employer that then participates in Social Security. Well, that changed. The government pension offset is the GPOs if you're a survivor. Um, an example is my dad. My dad gets a pension from the state of California. My mom passed away in 23. She was getting Social Security, and he didn't get the survivor benefit because he had the state pension. Well, because of the repeal of the government pension offset, he's now entitled to the survivor benefits. So, the Social Security Fairness Act was retroactive to 2024. So if you qualify, make sure you do. It's not automatic. Social Security's not going to contact you. So double check to see if you're eligible for it, and you'll get a retroactive check for 2024, and you get a retroactive check for 2025, and then you get your payments monthly thereafter. So using the lump sum election method could mean that you pay a lower tax on the retroactive benefits. No, you don't amend your 24 tax return. You just use this method here. So, it might help you reduce some tax. We have a new line here, 60. If you're married, filing separately, and lived apart from your spouse the entire year, check here. You're going, why is that question there? We have this thing called IRMA, Aunt Irma. Those are for those of you who are paying Medicare Part B and Part D. If your income's above a certain amount, you get hit with the IRMA, income related monthly adjustment amount surcharges. Now, the calculation is different if you're married filing separately, lived together, or lived apart. So that's why the IRS has this box here to let the Social Security Administration know when they calculate your Medicare premiums. New question there to consider. Okay, line 7, no change. Okay, line 8 is Schedule 1. That's additional income. There's more, right? So if you notice, we have 1040, Schedule 1, 2, 3, and Schedule 1A. So sorry, no postcard for a tax return. There's all these lines we got to consider. And then line 11 is your adjusted gross income. So AGI, right? So we have line 8 is additional income, line 10 are adjustments to income. That reduces your income, quote unquote, above the line. All right, here's page 2 of the 1040. Let's walk through that in a little more detail here. So the first part are your tax calculation and credits. Well, first of all, if for your standard deduction, you get a bump up to your standard deduction if you're over 65 or blind. If you're married, it's $1,600. Married filing jointly, it'd be $1,600 for both of you. That's $3,200. And you're considered to be 65 if you're born in before January 2nd of 1961. And I think blind is what, 20 over 200? Okay. So that's the standard deduction. And the IRS over here on the left hand column put down what the standard deductions are. You'll notice that's a little bit higher than what was announced because one big beautiful bill bumped up the standard deductions. 15,750 for single or married filing separately. 31,500 for married filing jointly or surviving spouse. Head of households 23,625. What does this mean? If you're married filing jointly, the first $31,500 of your income is tax free. That's the standard deduction. Now, if your itemized deduction schedule is higher, then you get to claim that. All right, line 13, we have the qualified business income deduction. You have a business, a flow through business or something like that. That's a free 20% deduction. That's still there. Line 13B, additional deductions from Schedule 1A. Those are those new deductions. We'll talk about that in a second. And from there, we get our taxable income. Then we check the tax table to figure what your tax bill is going to be, tax liability is going to be. And then we have some credits on Schedule 2, or additional taxes on Schedule 2, I mean. Here's the child tax credit from Schedule 8812, right? The CTC, child tax credit. And then we get other taxes that gives us our total tax here. All right. Okay, my mouse is not letting me move. Come on, move. Oh, here we go. Okay. And then the next part of the form is payments and refundable credits. So you have payments through your withholding, from your W-2, your 1099s. And then line 26 are your estimated payments. You could have a credit applied from last year's taxes. Here's a new box here to enter. If you made estimated payments with your former spouse in 2025, enter their Social Security number here. This caused a lot of confusion, right? You made estimated payments, but you were married the first part of the year, but you're not married the last part of the year. Who gets the credit for the payments? And that causes a fight, confusion, those sorts of things. So that's how we let the IRS know. Line 27 is earned income credit. Line 28, the additional child tax credit. That's $1,700 now if you meet those requirements. Line 29 is the American Opportunity Credit. This is the refundable credit. This is up to $1,000 if you have a child going to college. And this is new with the One Big Beautiful Bill is the refundable adoption credit. It's up to $5,000. So these all reduce the tax bill. So line 33 are your total payments. Okay. And then next part is that if your payments are greater than the tax, you have a refund. What's new this year? No more paper checks. We had an executive order by the president telling us that there's no more paper checks. No more paper checks. You have to do direct deposit. So enter your routing number and accounting number. I know. I hear, oh, I don't want to give the IRS my bank account. They already know. So, put it direct deposit. Now, if you insist on taking a paper check, it's going to be an extra 6 weeks. Extra 6 weeks. It'll take a lot longer. Um, it's a bad idea anyway. I had a client who had her refund check stolen because the mailman got mugged. And it took almost a year to get those replacement checks. And it's really creepy when you have someone sign your name on the back of the check. So, no, no, no. Direct deposit. All right. For refunds, we want direct deposit. If you owe, same thing. Yeah, yes, you can still mail in checks, but there's been some changes. One, the addresses have changed on where the payments go. It used to go to San Francisco. On this side of the country, it all went to San Francisco. Now it's going to Louisville, Kentucky. So that changed. Also, the post office have changed their rules on when you have considered to be timely mailed. It's not when you drop it in the mailbox. It's not the date on your postmark, your postage meter. You have to walk into a post office, have them stamp it, and give you a receipt to prove that you mailed it. So if you owe, pay it online. Go to irs.gov/payments. You can do direct pay. It's simple. It's easy. There's a confirmation. You can tell the IRS when to take the money out of your bank account. It's if you do it before April 15th, it'll be April 15th. Um, yeah, confirmation. It's a whole lot easier. Highly recommend it. Or do it through your tax software. So again, we've heard stories of checks that get stolen, the mail trucks get robbed, all kinds of bad things happen. Or if you remember a few years ago, um, back when the checks all went to San Francisco, well, what happened was all the checks went to San Francisco, California, Arizona, Nevada, I think Washington too, all went to the P.O. box in San Francisco. They load it on a truck. They go south on Highway 101, cross the San Mateo Bridge, and the checks are processed by Bank of America in Hayward. Well, I don't know if you remember the story. It made the local news. The truck had an accident and dumped a whole bag of checks into the San Francisco Bay. So the B of A employees had to get some nets and to fish out the checks, but the Bay saltwater washed all the information off the check. So what a mess that turned out to be. So pay online, pay it through your software. Okay. And don't pay for your credit card. I mean, they charge a pretty hefty fee on that. Have it direct debit out of your bank account. Line 38 is your estimated tax penalty. If you don't pay in enough during the year, there's an estimated tax penalty. So make sure you have your withholding updated. Make sure you make your estimated payments to avoid that. Uh, Third party designee, that's if you have a professional to your return, then we can call on your behalf to check on your refund or whatever. Sign your return. Okay. What does it say when you sign the return? It says, under penalties of perjury, I declare I have examined the return, accompanying schedules and statements, and to the best of my knowledge and believe they are true, correct, and complete. Declaration prepared if you have a tax preparer. If you have a professional preparer, prepare your return. They have to sign it. The bad guys are called ghost preparers. They don't sign the return. You have to get a copy of your return. You have to review it, read it before you submit it. Too many bad preparers are out there. So make sure you have a legit preparer. They have to sign the return. Right here we have the IP protection pin, and you can sign up for that. And it's a 6-digit number. The IRS sent you a letter in January giving you the 6-digit number. If you input that, send in the return, the IRS will say, "Oh, well, that's a legitimate return." Good idea. Same thing with kids. You can get an IP pin for the kids, especially when you're not married to the other parent. And you always have this fight about who claims the kids when they're not supposed to and all that. Get an IP pin, identity protection pin. So something to consider. Just go to IRS website and sign up for it. You need to verify your identity. Okay. Got to move along. Oh man, time's flying. All right, Schedule 1's additional income. Just want to point out that on the top here we have, if you have a 1099K, it's for personal items like, you go to Venmo, we split the bill or whatever, or you're selling stuff on, I don't know, Facebook Marketplace, I guess, or Etsy or whatever, but it's a hobby, it's personal. So you can input the number here, so it's not going to be taxable. But don't forget to input it if you get a 1099K. Don't ignore it. So report 1099K that was included in error or for personal items sold at a loss because you can't take a loss on selling personal items. Okay. Let's see. Just point out a couple things. Gambling, if you get W2G, report the gross amount of winnings, not the net amount. Report all your gambling income, not all of it's on W2G, especially your claiming gambling losses. All right. If you have cancellation of debt, you settled a credit card or something like 1099-C, it's taxable. Okay, so don't forget to input that to include that. Let's see. Scholarships and fellowship grants on W2. So these kids nowadays, oh my goodness, they're getting these huge scholarships, way in excess of what their tuition is. Well, guess what? The excess is taxable. Don't forget about that. And then there's line V. Digital assets received as ordinary income and not reported elsewhere. So if you do staking, lending, or whatever, that's where that goes if you're dealing with cryptocurrency and those kind of things. All right. Back of the Schedule 1 is adjustments to income. So just a couple of things here. If you're self-employed, you get the half of your self-employment tax is deductible. But you've got till April 15th to fund your IRA. So you can, if you want to reduce your tax bill, you still got to April 15th to fund your IRA. You can also top off your health savings account. That's line 13 here. In case you haven't topped it off, you got to April 15th to do that. Same thing if you have SEP or a retirement account if you're self-employed. And don't forget to deduct if you're self-employed health insurance deduction. And that includes Medicare. All right. The rest is a bit obscure. All right, let's move on to Schedule 1. These are the new deductions. No tax on tips, no tax on overtime, no tax on car loan interest, enhanced senior deduction. So here's Schedule 1, page 1. Here's page 2. We're going to more detail. So they're all limited based on income. All the amounts are a little different, but in this case here, part 1 is modified adjusted gross income. It's basically the amount on the bottom of the first page of the 1040. For most of us, we don't have these adjustments. We don't have Puerto Rican income, American Samoa income, and most of us don't have foreign income exclusion or housing deduction exclusion. But so generally it's your adjusted gross income. Let's talk about no tax on tips. It's up to $25,000. It's just only on income tax, not the payroll tax. It applies to if you're an employee or an independent contractor. And it's temporary. It expires in 2028, but it's for people who are in traditionally and customarily tipped industries. Now, this can apply to you if you own a hair salon or a nail salon or a restaurant or whatever. So you got to make sure your payroll service is doing this correctly. And I say payroll service. Don't you dare do your payroll on your own because it's too complicated to do it yourself. Because us tax guys are stuck fixing your mistakes. So use a professional payroll service to do this correctly. Now, there's income limits here that starts at 150K for singles, 300K for married filing jointly. Now, if you're married filing jointly, if you're married, you have to file jointly. And the IRS gives us a list of top tipped occupations. As long as you're on that list, you can take advantage of it. You have to have a social security number. You have to have a social security, no ITINs or whatever. So, for the tips, the number that's on box 7 of your W-2, or if you're reporting tips on Form 4137. If you're self-employed, like an Uber driver, Lyft driver, DoorDash, or whatever, the income's on your 1099 NEC or 1099 miscellaneous or even 1099K, but print out your year-end statement because it'll show the amount of tips. I ride Lyft a lot, so I talk tax planning with my drivers. All right, so here the max is 25,000. It's for unmarried, it starts at 150. You fully phase out 400. If you're married, the phase out starts at 300. You don't get any of this if you're over 550 of income. So what are qualified tips? They gotta be voluntary. We do that at the restaurant, put an amount down. If you see an iPad, you know, it has to give you an option of no tip, give you an option of changing the amount. If it's a mandatory tip, it doesn't qualify. I was just at a restaurant last week they charge 20% no matter what. And I talked to the waiter. I said, you got to talk to your boss about this. He just cheated you out of a $25,000 deduction. And I go call your boss. I want to talk to him about that. So it's on my receipt. It was an automatic charge for the tip. So it's not a tip, it's a service charge. All right. As long as you're on a list, you can deduct it. So what are not tips? Mandatory service charges. You have a large party, they put a automatic gratuity on it. That doesn't count. Um, Payments the employer requires to control. So let's say I okay, a lot of people get bad advice from social media. Don't do that. So I keep hearing from these people who are hairstylists and they were told to be an S corporation and they get tips as a hairstylist and all that. Well, you're the owner of your S corporation. Sorry, you don't get this tip deduction. That was bad advice you got. So watch out for that. Okay. If you don't report your tips, that's not deductible, all right? Make sure you deduct your tips. Non-cash items, some people get gift cards, wine, or whatever. Those don't count. You got to be on the list. Employer paid bonuses and incentives. So the IRS gave us this nice handy dandy list here. The first group are the beverage and food service. So no surprises here, really, right? That's the 100 series. The 200 series are entertainment and events. Then we get the 300 series, hospitality and guest services, right? And then we got home services. Someone got offended when I made a plumber joke, so I'm not going to make a plumber joke, but plumbers do qualify for the tip deductions. If you tipped your plumber, they got to deduct that. Personal services, the 500 series. Personal appearances and wellness, that's what number are we at? 600 series. Recreation instruction. Hey, you tip your golf caddy, he gets a tip deduction. 700 series. Transportation is the 800 series. Parking attendants, shuttle drivers, and those kind of things. So those are the tip deduction. Now we have no tax on overtime. Um, a little bit different here. The maximum is 12,005 if you're single, 25,000 if you're married. Doesn't matter if only one spouse gets overtime. They also have a phase out. For unmarried, it's 150K is when it starts. You max out 275. For married, it starts at 300. You don't get this at 550 and above. Same rules. You have to file jointly if you're married. You have to have a social security number. And so you got to look at your year-end pay stub. Some employers are giving a report that says, oh, you can claim this much as qualified overtime. That's great. All right. So this is for the no tax and overtime. So it's basically if you get overtime, the deduction is only limited to the excess amount, not the whole amount. And it's overtime is defined under the Fair Labor Standards Act, Section 7. So the deduction is defined as the amount paid in excess of your regular rate. So here's an example. You make 22 bucks an hour. So one half times of that is $33 an hour. Well, in this case here, he makes 16.5 in overtime, but that's not the deduction. It's going to be the $33 minus $22. The difference, so that's 5,500, and that's his overtime deduction. So, if he's in a 12% bracket, he'll save $660. So, what's the controversy? What is not overtime? Premium pay. If you're a union employee, have collective bargaining and it pays more than Section 7 of the Fair Labor Standards Act, that doesn't count. Payment for holidays and weekends doesn't count unless you work more than 40 hours in a week. Tips, of course, don't count. And then we got California overtime, which is a little bit different. So It's so this is only for overtime that you get when you work more than 40 hours in a work week. In California, California overtime kicks in when you work more than 8 hours. So if you didn't work 40 hours, you have a part-time worker and you worked more than 8 hours, you got overtime, or you got double time, you worked 12 hours, but you didn't work 40 hours in a week, it doesn't count. So that's something we got to look out for. A little bit complicated to figure out this year. Again, if you're the employer, you own a business, you pay overtime to your employees, make sure your payroll service is tracking this correctly and reporting it. All right, no tax on car loan interest. So this is for new cars you purchase in 2025. Doesn't matter if it's a 24 model or whatever year it is. It's going to be a new car in 25. It's going to be a car loan secured by the car. It's got to have at least two wheels. Doesn't apply to campers or RVs. It's got to weigh less than 14,000 pounds. The maximum is $10,000 that you can deduct. Phase out starts at 100 for singles, 200,000 for married filing jointly. So here's an example here. Let's say you pay $3,200 in car loan interest for 2025. You deduct the entire amount because it's less than $10,000. Now, what if you pay $12,004? Well, you can only deduct up to $10,000. So the IRS has given us some more guidance here. If you use your car for business also, well, it's got to be more than 50% personal use. So if you inherit a car with a car loan, as long as that loan qualified, you can still deduct it if you inherit a car with a car loan. Now, the amount of the loan, if you use the loan to pay for a warranty, sales tax, and those kind of fees, that's okay. However, you can't use the car loan to buy a trailer, pay for insurance, or in some cases, people turn in a car, a used car that comes with a loan. That negative equity does not count. So let's say you turn in a car, you still owe 10,000 on it. So that's rolled into the new loan. Well, that $10,000 piece doesn't qualify for this. If you refinance, if you don't increase the balance, not a problem. If you add to the balance, well, the additional is not going to count. So you got to watch out for that. All right, cars got to be made in the U.S. And guess what? My son got a Toyota Camry. Well, that was assembled in Georgetown, Kentucky. A lot of Toyotas are here made here in the U.S. Those cars qualify. Some Hondas, the BMWs, the huge factory in South Carolina there. So there's a VIN decoder. You type in the VIN number, the make and model of your car. It tells you where it was made. So you know that it was assembled in the United States. So you need to put in the VIN number of the car. And if you deduct it on your business returns, you got to back that out, if you're Schedule C, E, or F, and the rest will be deductible. But if you notice, the income levels are a little bit different than the other deductions. It starts at 100 if you're single, but you cap out 150. At 200 if you're married, you cap out 250 there. So, and then we have a new form, 1098 VLA. You probably won't see that this year because it was just issued. We'll probably see it next year. But all the boxes here for all the data we need to fill out the form. Okay, let's talk about the enhanced deduction for seniors. I don't know about you. I yell at my TV a lot. And I just heard CNN repeat it again. And it says, no tax on Social Security. That is wrong. This has nothing to do with Social Security. So go yell at the TV for me too and tell them they're wrong. Well, what's worse is that we get an email or a letter from our very own government, our very own Social Security administrator saying there's no tax on Social Security. Don't do that. That's misleading. So, yeah, if our politicians and government officials keep misstating this, yell at them, call them out on it. The enhanced deduction for seniors has nothing to do with Social Security. Now, if you're married, you have to file jointly. You have to have a Social Security number. So if you have an I-10 or whatever, that's not going to count. It's up to $6,000 a person. You got to be 65 or older, which means you're born before January 2nd of 1961. And this is on top of those bump up on your standard deduction. $1,600 for married filing jointly, $2,000 for unmarried. Fades out a little bit lower here. 75,000 for unmarried, 150,000 for married filing jointly. So if you're single, it starts at 75, you phase out 175. If you're married, it's 150 to 250. What's the mistake I see people making? They take big amounts of money out of their IRA. They do a Roth conversion and they blow themselves off this deduction. It's only temporary. It expires in 25, 28, 28 is the last year of it. So do some super duper careful planning to not knock yourself out of it. You know, don't put your income above these amounts. Otherwise, you'll cheat yourself out of this deduction. So we'll see this. This is something you got to be careful about, right? Because I see people do dumb things like they take a big capital gain or they do a Roth conversion. Why are you doing that? You just cheated yourself out of a possible $12,000 deduction. Don't do that. All right? Don't do that. Okay. So all these get totaled. It flows to line 13B for additional deductions. Okay. Ooh, we're getting short on time here. So I'm going to move kind of quickly, remainder here. I hope this was helpful. Schedule A, itemized deductions. We might be itemizing this year because taxes you pay, state and local taxes, the SALT deduction, right? No change to medical. We still have that. It's got to exceed 7.5% of your adjusted gross income. Okay, that's for medical. But for the state and local tax deduction, this used to be $10,000. Now it's 40,000. So, I told my wife to pay my second property tax installment by December 31st so I can deduct it on our 25 taxes, right? I paid my fourth quarter California estimated tax payment on December 31st so I can deduct it on this year's taxes. So that's a big change we have here. Okay. Mortgage interest, no change there. It's still for loans you get after 2017, it's still limited to $750,000. No change there. But California is different. We'll talk about California at the end here. Charitable. Next year, there's going to be a charitable deduction for non-itemizers. So that starts in 26, not 25. $1,000 for single, $2,000 for married filing joint. That's next year. What's also new next year is there's a reduction to your charitable contributions. Um, you're going to lose 0.5% of your adjusted gross income from your charitable deductions starting in 26. This is why I'm such a big fan of the qualified charitable distribution. Casualty and theft losses. Um, it's got to be related to a federally declared disaster, so no change to that. Line 16, that's where we can claim our gambling losses. Gambling losses get claimed here. Gambling winnings get claimed on Schedule 1, Line 8A. Gross goes there, you deduct it here. But you can only deduct it to the extent of gambling winnings for 2025. Starting in 2026, how much can you deduct? Yeah, 90%. Boo. So that starts in 26. Yeah, yeah, yeah. So that's going to be next year. So these are total itemized deductions here. Okay. All right. Hold on for a second here. So our next topic is the Trump account. That's new. A new savings vehicle. Okay, you don't like Trump? That's fine. Call it the 530A account. Okay, I'm going to call it the 530A account. It's for children 18 and under. They start on July 4th of 2026, but that's a Saturday, so it's really Monday, July 6th. The money grows tax deferred. Of course, the beneficiary will have to pay taxes on it when they take the money out. The parents, grandparents, friends, and family can put up to $5,000 a year, and that might be adjusted for inflation later on. But 5,000 a year. These are permanent. These are permanent, so this is not going to expire. Employers can also contribute to an employee's Trump account. It's up to $2,500 per employee. Now, they got to have a kid that's under 18 years old. Doesn't matter how many kids. So the employer can contribute to an employee's Trump account. They get the deduction for the 2,500. 2,500 is tax-free to the employee. And then next year, we'll have a new code on the W-2 code, TA. Okay. All right. These are for children, eligible children under age 18 at the end of the year. They have to have a Social Security number. They have to be a U.S. citizen. The responsible person goes in this order. It doesn't have to be the parent claiming the child as dependent. It could be a legal guardian, parent, adult sibling, or grandparent. So there's a new form, Form 4547. Ha ha ha, you get it right. Form 4547. You file the tax return, or you can send it separately, or send it electronically separately, or you can go to trumpaccounts.gov, put your email address in there, And then maybe sometime in May, we'll get the activation process and all that. So if you have a baby, 25 to 28, you get a free $1,000, but you have to elect it. Also, Michael and Susan Dell contribute $6.25 billion for children aged 10 and under living in zip codes and median incomes below 150,000. You have to opt into the Trump account, you get $250. That's $250 for Michael and Susan Dell. Here's Form 4547. So the top part is the parent or guardian authorized individual. Part two is the kid's information, their name, address, social security number, date of birth, relationship, and all that. And then part three, pilot program contribution election. This is for the free $1,000. This doesn't matter what your income is. It doesn't matter what your zip code is. Every kid born 25 to 28 is going to get this $1,000. You need to check this box to get it. And then maybe sometime in June or July, we'll get some information from the Treasury about setting up the account. Now, you can roll this over to your own Trump account. It doesn't have to be whatever the account they set up. And it can only have one investment. It's the S&P 500. All right. Okay, here's the trumpaccounts.gov. Not very informative right now, but maybe they'll give us more information. Whew, okay, that's federal. Let's go over California here. So I'm gonna go through this pretty quickly. So California's Form 540. So got some new boxes to point out here. So there's no 540X anymore. There's an X form. But if you're amending a California return, you check here for amended return. And also, because of people changing names or whatever, if you had a prior name, if you had a different last name, or you just totally changed your name, um, put your prior name here so they can match up the records and all that. Now, California, we have something called a registered domestic partner. Doesn't matter if it's same sex or opposite sex, it's just a different status. So, for California tax purposes, you're treated as if you're married. Federal purposes, you're not. So, for federal, in California, you might have different filing status. So if your California filing status is different from federal status, check here. So you got to watch out for that. And so you can be filing jointly, you can be qualified surviving spouse, or you can file separately. If someone can claim you or your spouse as the dependent, check this box here. So the dependent exemption on California is $475. California did not conform to the Tax Cut and Jobs Act, so it's got the lower standard deductions here, unlike the higher ones for federal tax, refundable credits. I'm just going to point out the things here. Okay, so if you're renting, there's a non-refundable renter's credit. Um, Line 62 is the Behavioral Health Services Tax. That used to be called the mental health tax. So if you have income of a million or more, you had to pay an extra 1%. So I guess they changed the name to Behavioral Health Services Tax. If you have withholding, your W-2, your 1099s. Also, if you had a real estate sale, the state might have withheld some money there. So make sure you report that. That's the number one mistake I see people make. They sold a piece of real estate, the title company withheld some money, but you didn't claim the withholding. And guess what? The state's not going to tell you that, oh, we had $10,000 of money paid in. You got to claim that. They don't do that. So you have to make sure you claim that. A couple of new credits here, Young Child Tax Credit and Foster Youth Tax Credit. All right, line 91, use tax. If you buy something that you didn't pay sales tax on, you have to pay use tax on because you're using it in California. What's the most common thing we see? Yeah, buy stuff overseas and you declare it to customs. Who gets the customs form? California, right? So if you bought something overseas, you didn't pay sales tax in California, you got to report it in a use tax form. You go to New York, one of those fancy art auctions, there's always a FTB agent there. They say, oh, he's in California. We got to make sure we collect sales tax from him. So don't forget to do that. 992 is the individual shared responsibility penalty. California requires you to have health insurance. That includes Medicare and all that. So you have to have medical insurance. If you don't have medical insurance, you pay a penalty. So keep an eye on that, all right? Let's see what else we have here. Oh, I just want to point out we have some new contributions. So in California Forum, you can contribute to all these different funds here. We have a new one. A new one is the California Pediatric Cancer Research Voluntary Tax Contribution. If you contribute, that's great. You get deducted on your 26 taxes. So don't forget to do that. We have the State Parks Protection Fund Parks Pass purchase. So if you give at least $195, you'll get a California State Parks Pass. All right, there's the website here, parks.ca.gov/annual pass. So at least $195 if you want that free annual pass. I think it's got a bear on it, so there's no picture of Gavin Newsom on it. All right. Okay. Then we get the payment. So California does not have the mandate of no paper checks, but I still think it's a good idea to have direct deposit of your refunds and direct debit for any money you owe. Okay. Yeah, so you enter a routing number and account number just like the federal here. And here in California, we've got a box here for voter registration. If you want to learn more about that, check the box. Uh, if you want to learn more about Covered California, yes, you can check a box there. And what's new is if you want to donate your organs, organ donation election here, you can check the box to be on the list for organ donations. And I know, I guess your driver's license is not enough. They want it on the tax form too. Okay. All right. So Schedule CA are the federal California differences. I'm going to point out what's new for this year. So what's new for this year, starting this year, is that we have the military retirement exclusion that's up to $20,000. I didn't know this, but California was the only state that didn't have a military retirement exclusion. Some states it's completely tax-free. Some states there's a dollar amount. So for California, it's up to $20,000. So if you are getting DFAS, DFAS, or if you're a survivor, don't forget to claim this exclusion. It's not going to be automatic. The state's not going to do it for you. If you're using tax software, it's not going to do it automatically. Okay, so don't forget about that. All right. In terms of, oh, gambling. Yeah, gambling income. Let me go back here. What do I have here? Did I have interest income? Yeah, interest income. If you have interest from U.S. government obligations, it's tax-free. Savings bonds, T-bills, T-notes, and those kind of things. Don't forget about that. Also, if you have a mutual fund, a percentage of that could be coming from those type of bonds, not taxable for California purposes. So don't forget to subtract that. Otherwise, you're overpaying your California tax. Okay, if you win the California lottery, it's tax free. Go figure. I don't see a problem with that, but that's the way it goes. So it's tax free. And again, tax software doesn't automatically do that for you. Don't rely on tax software. It doesn't think for you, okay? So it just fills out the forms, but not necessarily correctly. So don't tax software doesn't replace a tax professional. All right, this is just a little list here to remind you. U.S. savings bonds, those are generally tax-free. T-bills, T-notes, T-bonds, any other bonds or obligations of U.S. and its territories, that includes Puerto Rico, okay? And I didn't know this, but the Ottoman Turkish Empire settlement payments, I've never seen that. So, that's tax-free. Okay. Yeah, mutual funds, read the details to the mutual funds. Gambling, California lottery winnings are not. But if you have a lottery win for another state, that is taxable. Now, see here, cancellations of debt. Federal and California law is different on the mortgage forgiveness debt relief. Same thing with student loans. So it might be tax-free for federal, might be taxable for state. So you got to watch out for that. Got to be real, real careful about that. So there are some federal state differences. It's called conformity. Yes, we had a new law here, SB 711, which brought California conformity up to January 1st of 2025, but there's still a lot of differences here. Unfortunately, we don't have enough time to go into all the specifics about the conformity law. Let's see what else are. These are the adjustments. Anything to point out here? Let's see. Yeah. So So for California purposes, you can't deduct California state income tax, but you can deduct the full amount of property tax. So if you pay 50 grand in property tax, that's all deductible on the California return. It's not limited to $40,000. Interest, the California interest deductibility rules are different than federal. For California, it's up to $1 million and also includes up to $100,000 of home equity interest. So, that's different there. Okay, so there's a differences of what's deductible for federal purposes and state purposes. Also, California did not adopt the elimination of the 2% of AGI limitation deduction. So for California purposes, we can still deduct our tax prep fees, our investment fees, unreimbursed work expenses, home office, if you're working from home for an employer. So for California, still deductible. If you pay your financial advisor, investment advisor, those are still deductible. Legal fees to get your living trust done for California purposes, still deductible. So that's still there. All right, that takes us to that. And then just to point out that there's people are trying to get signatures for this new billionaire tax. They're trying to get on the ballot for November of 26. They need to gather 870,000 signatures. So you probably see them in front of Safeway or whatever, trying to get your signature. It's a 5% tax for anybody who has over $1 billion. I don't know. They think it's two to 300, but I think that number is dropping as billionaires are running out of the state to avoid being taxed on this. So basically, they're being taxed on anything if they're worth over $1 billion, and just an exclusion for real estate and retirement assets. But there's other initiatives to go against the billionaire tax. There's the Budget Stability Act, the California Residency Rules Act, the Protect the Schools and Taxpayers Act, the California Government Efficiency Improvement Act of 2026, and the Retirement and Personal Savings Protection Act. Okay, so that's what's going on here. We'll see what happens with that. So this takes us to the end here, and I noticed we had quite an active chat and Q&A. So Jonathan, do you want to turn off the recording or leave the recording on while we go through these questions?
Um, are you okay with leaving the recording on, Larry? I
It'll
don't,
it'll make this a longer video if people
okay,
don't
I think
mind.
you cover a lot of good information answering these questions. So,
Okay, let me take a look at this here. So bear with me, and I think I need to get my glasses. So bear with me here. So we have quite a few here. So if it's something I can answer, I certainly will. If it's something I can't answer, I won't. So I'm gonna go to the top and work my way down. Let's see. First one is, what do you think of? I can't comment on any retail software because I'm a tax professional, so I can't really comment on that. But hey, it's not the software, it's the pro. Okay. We go through a lot of training and education. So in terms of, and I think Jonathan, you're going to have someone from the low income tax rate talk about how to select a tax professional. So that's a really important. I have a tip on that. Nobody who advertises. If they advertise, I probably wouldn't go there. Best way to find a tax pro is a referral for someone in a similar situation to you. If that person's happy with their advisor, then that could be a good call. Don't go to someone who's a different situation than you, then that might not apply. All right, someone's asking about ETFs here. Okay, so that's a good question. In terms of digital assets, one way to getting around all these complicated digital asset rules is buy an ETF. An ETF is an exchange traded fund. It's an investment on that. So they don't because they're securities, so they follow the securities rules, which are different than the property rules. So it's a little bit of a technical difference here. If you're divorced, can you file as head of household? Yes, you can. That's one of the definitions. If you're single as of December 31st with a qualified dependent, you can file as head of household. Go through that ITA on what my filing status is to make sure you qualify for head of household. Kimberly's got a question about HSA. If you have an oops, you guys are posting more questions, so my questions keeps moving away. If you have an HSA for your job, you lose your job in August, can you still put the whole amount into the account if you don't believe you left a job. So, oh, okay. So let's say, and I don't have the numbers memorized here, but let's say you only put $2,000 in your HSA and then you left your job. We get to April 15th to top it off to the maximum amount. You get an extra $1,000, you're over 55. So you get to April 15th, and that's reported on Form 8889. Okay, all right. Oops. Lorinda, I turned 73 on December 26th and made an RMD to a poor relative. So far, no paper for Schwab, which I had to count. What is the deadline? Well, I can't answer that question. You have to ask Schwab. But if you took a distribution, doesn't matter if it's an RMD or not, from your IRA account or 401k or whatever, you will get a 1099-R. So, it's still early in tax season, so it might not have been issued yet. Check with them. Okay, what does the FBI not know? I don't know, but they knew. They do know. I mean, they're experts on cryptocurrency. They are extremely expert. So is the IRS. They've been focusing on that. They got pros on that. Don't be cute and think you can be sneaky about it. They know about it. We've got tax cases on it. If you're bored, look up a character. I forget what his name. He's actually here in the Bay Area. He's known as the Bitcoin Jesus, and I think he's back in the United States now. He was trying to escape. He was being extradited. Fun story. Bitcoin Jesus, look him up. I think he's settled with the IRS. Where would I enter my senior deduction? Okay, we talked about that, Vicky. Form Schedule 1A, right? Bottom of page 2. Is there a fee to electronic get a refund? No, there's no fee. Direct deposit with your bank account, no fee. Do you have to include the QCD proofs with the form? Where do you subtract the amount? Okay, you don't have to submit the documentation, but you should have it in your files in case the IRS asks. And I think it's a good idea to do it now because it's kind of a pain to get it later. So get it now. The thank you letter from the charity and the receipt showing your distribution from your IRA going to the charity, not to you, and a picture of the check that says payable to the charity. All right, we talked about Schedule 1A. What's the deduction for seniors? That's the additional $6,000. Okay, Vicky. All right. Okay, that's good. That's good. Okay. What is the gambling deduction? So that's when you have gambling income, you can claim against it gambling losses, but you got to be real careful about the documentation and the calculation of that. That's reported on line 16, I think, on Schedule A. Can you pay money owed electronically if your tax returns are on paper? Don't file on paper. Do not file on paper. The IRS has already told us that's the kryptonite. Do not file on paper. Also, if you respond to an IRS notice, do not send them a letter. Do it through the document upload tool on the IRS website. Papers are kryptonite. It'll take about a year for them to process it. So don't do that. They no longer have the IRS is down 23,000 people as a result of our good friends at Doge. So the IRS has lost their top layer of people. So that's where all the brains are and all the experience and all the expertise. And then they got rid of the new people because they had their probationary, they had no union production. So we got a whole bunch of grumpy middle people, and they might not be that well trained. So be real careful. All right. So do not file on paper. That's just a do not. Don't even do that. Don't even try. Do it electronically. Okay, what is Schedule R? Well, you can look that up. Schedule R is a credit for retirees. Okay. Taxi drivers tips on the list. Yeah, yeah, they're on the list, of course. The Uber drivers, the Lyft drivers, they're on the list. Iris PIN, is it too late? Yes, too late for 2025 because you had to get it before November of last year. But you can get it for 26. Okay. How to qualify foster child credit. Okay, that's the adoption credit. Adoption credit. I don't have the form number memorized, but check out the form. Check out to see if adoption benefits through your employer too. And if it's a special needs child, you get the full credit without incurring those actual expenses. What if my what if my tax file last year made a mistake? How can I amend it now and in penalty if no taxes owed? That's a good question. It depends. If you made a mistake, you can always file an amended return to correct the mistake. Are union dues taxable? And if we pay them, do we need to report them? Is there deduction credit for no? Unit dues are not deductible on the federal return. It is deductible on the state return, but not on the federal return. What about preferred deposit accounts? I don't know what your question is, anonymous attendee. Okay, can you still get a mail check for refund? How do you pay for estimated tax? You can't get a paper check. It'll take at least an extra 6 weeks to get it. All right. And you can still pay with the 1040V, the voucher, or 1040ES. The IRS has changed the addresses, so you have to be very careful about that. But no, pay it online. irs.gov/direct pay. Much, much easier because you get a confirmation number and all that. And also they'll ping your account to make sure the account is good. If we claim a parent as a dependent, are they eligible to claim any credits or deductions? Do they need to file a separate return to claim these? Well, that's a good question because, and I don't have the number memorized off the top of my head. If their income exceeds a certain amount, you cannot claim them as a dependent. So if they are entitled to any credits or whatever, it's only worth $500 anyway. So check with your tax advisor on that one. If I pay my tenant's buyout, can the expense offset my rental income? Yeah, okay. All right, you must be a landlord anonymous attendee. So in San Francisco, we have to, pay our tenants for them to leave, right? Well, they need to get a 1099 from you. So make sure you file it. If you want to deduct the buyout amount, you need to issue a 1099. So I've done that for clients who had to pay off their tenants, and then I get this really angry response from tenant. Are you gonna pay tax on this? Of course you are. You're getting 65 grand. You got to pay tax on it. Oh, that's not fair. Well, too bad. So anyway, yeah, you have to pay tax on that buyout. Issue them a 1099. All right. Because if you don't issue a 1099, state of California will not allow deduction. All right. Don't go there. If a house is put in trust, can the property taxes still be claimed as deduction? Oh, yeah. Well, if you're talking about a living trust, yes. A revocable living trust, yes. Is Social Security income not taxed in California? No, it's not taxed in California. It's one of the adjustments on Form CA 540. Okay. I had an instrument bought overseas and shipped to me that's over 100 years old. Vendor said there's no taxes because it's over 100 years old. Do I need to declare this on use tax? Yes, you do. You bought it overseas. And I don't know where this vendor is making this stuff up. Don't get your tax advice from unqualified people. So no, it's subject to use tax. Whatever you paid for it, you bought overseas. Yeah, you got to report that in the use tax. Now about California. Well, what about the California non-refundable credit? If you're renting, there's a renter's credit. Okay. All right. Okay. I overheard that. My questions keep bouncing. I overheard that you can deduct cost of hiring a trust attorney and setting up a Roco trust uh, on the California return, because those deductions still exist, not on the federal return. What is the income limit for a low income tax claim? I can't answer that. Ask them. Ask them. They're a great resource. I volunteer for them before, and check with them on that. In terms of the tax dividend gain, will you suggest ETF or individual stock? That's more of an investment question. So, so I really can't answer that. From a tax standpoint, same difference. Are payments to financial advisor deductible on your California taxes, not your federal? Okay. If your spouse died in May, can you take the both enhanced deductions on Schedule 1A? Yeah. Yeah, yeah. Because you're still filing jointly. You're still filing jointly on the 25 return. On the 26 return, you'll be filing a single. So, all right. All right. Are taxi tips on that list? Yeah, I forgot what series they're in. Is it the 600s? I don't know. Take a look at the list. Okay. All the amount to HSA will need to be added back for California return as taxable income. Okay, here's the thing. California does not conform to HSA, so there's a deduction on the federal return, no deduction on the state return. What's the gambling tax rate? It's based on what your tax rate is. Okay. If I purchased a car in 2003 and had a loan, can I deduct the interest payments I made in 25, 22? No, the answer is no. It has to be a new car purchased in 25. The loan's got to be secured by the car. Also on the senior benefits, say, can you make more than say you can? Yeah, there's a phase out. There's a phase out. So, if you're above the bottom amount, but if you're in the phase out, you get a portion of that. It's a calculation on the form. You can figure that out. If I get a K1 for multiple states, do I need to file tax returns in all the states or just the state within which I'm a resident? Well, that's a good question. So, yeah. Yeah, if you get a K1 for multiple states, like let's say you're in a real estate partnership and they have a property outside of California, yes, you have to file a non-resident return for that state. However, you'll get a credit on your California return for whatever state taxes you paid in other states. However, depending on the partnership you're in, some partnerships will ask if you want to be part of the composite return for those other states. So it depends on the partnership you're involved in. I have to file on paper, okay, and I have to pay. So can you please answer a question on whether I can pay electronically? Yes, you can. You can just pay on irs.gov/payments or direct pay. iris.gov/payments. Okay. But do not file on paper. Bad idea. Okay. My advisor passed. All right. Is this a question? Thank you. Thank you, Jonathan, for offering these opportunities. Okay. I am responsible for filing for myself and for my elder retired parent. I made mistakes last year. I'm overwhelmed for 25. Okay. All right. Well, good luck. All right. What's the process of resigning I-10 due to receiving SSN? Since it's not suggesting since it's not suggesting IRS a letter requesting resignation, what's the alternative method? Ooh, uh, yeah, that's a good one. Usually what happens, and this could be quite interesting, that if you had an I-10 and now you qualify for a Social Security number, if you worked and you paid into Social Security, you can have those credits applied to your Social Security account. So my answer to that question about the I-10 no longer need, go to your Social Security office and explain this to them and see if they can move over the Social Security credits from that was paid under the I-10 account. What is the new California law on inheriting my house when I pass on? Will they pay any taxes on the original price? Okay, so this question is based upon Prop 19. Prop 19 is regarding property taxes, and that's beyond the scope of this course. We can do another course on Prop 19 if you'd like. So let Jonathan know if you want to talk about Prop 19. That's a different class. Is a backdoor Roth limiter or change in 2026? We're going to stuff to do it right. Again, we can do a class on Roth IRAs. We talk about the backdoor Roth. It's a bit complicated beyond the scope of this group, but we have done this in the past, and I'll be more than happy to do it again. Okay, let's see. Do I need to pay taxes on interest income? Well, yeah, that's part of your adjusted gross income, so don't skip it. Don't skip it because if you leave it out, IRS will send you a CP 2000 notice because you left off that income. Okay. If you have renter's income and no 1099 from them, do you need? Oh, yeah. You have to report all your income. It doesn't matter if you get a 1099 or not. You have to report all your income. Just because you don't get a 1099 doesn't mean it's not reportable. That's a big mistake. Are any my beneficiaries on my IRA investment accounts reflecting on living trust? What taxes are they going to pay when they take the assets after I pass on? That's a different course beyond the scope of this here. But here's a tip. Don't name your living trust as the beneficiary to your IRA. Don't do that. Don't do that. That's complicated. And also trusts have a high tax rate. So, that could be another class. So Jonathan's taking notes on classes we need to do. That's a whole other class. Could you replace what you said the surviving spouse needs to do? Anonymous attendee, I don't know what your question is about specifically, so I don't recall what that is. Okay? Can't do paid capital gains can be written off. I don't understand that question either. Okay. If I got IRS penalties that I cannot e-file and claim certain credit, how long does the ban? I don't know what your situation is about, so I can't answer that one. Okay. A lot of people went Prop 19 class. Okay. What if you don't receive a 1099? How will the government know? The government knows everything, all right? Okay. They do. I'm involved in the case right now. Okay. Can you please repeat what steps to take for amending? That's another class here. And I think our good friend Heather is going to talk about that in her class upcoming. I think so. I don't know. Heather, correct me. If I have a legal settlement, do I pay taxes on it? That's a good question, and that the answer is it depends. Again, we need more details on that one. If I execute a revocable living trust with me as trustee, will I file fiduciary return? No. Revocable living trust is known as a grantor trust. It's invisible while you're still alive. But you put your house in there, your brokerage account in there. Don't put your car in there. Don't put your checking account in there, and do not name your IRA beneficiary as the living trust. But upon your death, that's when it pops up and it becomes an irrevocable trust, and that's when it's going to have to file a tax return. Okay. All right, Jonathan. I think we're getting towards the end here. Let me see. I think we answered all the questions, haven't we?
Yeah,
Uh,
that was amazing.
yeah.
Um,
Yeah. I think we got through all the questions that are in your list here. Oh,
yeah.
I'm kind of pooped
Um,
now.
yeah, no, and there were definitely some thank yous in there. Yeah, thank you so much, Larry. Your presentations are always so informative. They contain so much information, and I know this is I think a tricky tax year for everyone with new rules and a lot of misinformation out there. So we really appreciate you coming and talking to us about all of that. Um, I want to remind everyone that I will be sending out a follow-up email later today, probably by 6 p.m., that'll have a link to a recording of this presentation and a copy of the slideshow. I'll also include some information about our upcoming programs. Um, we have a bunch more tax programs coming up. Please check those out. They'll be covering different topics than we've had today and at the last one a couple weeks ago. I will also include a very short evaluation survey in my email. Please take a moment to fill it out. It'll only take a minute or two. We take your responses seriously. It helps us improve our programs and offer programs on new topics. So, like Prop 19, if there's things you want to hear about at the library, let us know in that survey. Um, and I think, yeah, we are out of time today. Oh, I see there's one question. Yeah, this will be on the library YouTube channel. And yeah, you can see a lot of our other programs on that YouTube channel as well. Please go check that out. Um, all right. Well, thanks
All
again,
right.
Larry.
Well, thank you, Jonathan. Please highlight the upcoming programs you have. You have February 27th, how to choose a tax preparer, right?
Yeah, so we're gonna this Friday, February 27th, the Low Income Taxpayer Clinic will be here with how to choose a paid tax preparer. Then on Friday, March 6th, we'll have supporting your family through the tax system. It'll go over special considerations for caregivers and families and tax strategies. Um, and then on Thursday, March 19th, Heather Liston, another one of our favorite presenters, will be here to talk about how to stay out of trouble with the IRS. That's always a really great presentation. Please join us. And then on Wednesday, March 25th, we'll have a program, a practical guide to taxes for artists, creatives, and freelancers. So if you fall into any of those categories, this will be a very valuable presentation. It's a collaboration with California Lawyers for the Arts. So please join us for all of those upcoming events. Um, all right. Well, everyone, thank you for joining us. Everyone that stayed for the whole presentation today, and I hope to see you on Friday and at other future events. And thanks again, Larry. All
All right.
right.
Thank you, Jonathan. See you again.
All right. Take care, everyone.
Take care.